Welcome to Breaking News to Trading Moves.
Glad to be here for this one.
Yeah, so before you board a flight, especially a long one, you generally check the weather, right?
Oh, absolutely.
And I don't mean just a quick glance at the temperature. I'm talking about a highly detailed aviation forecast.
Right, you need the specifics.
Exactly. You are simply trying to understand the exact conditions you are flying into. You want to know where the turbulence might hit, how severe it could be, and, whether the plane is actually equipped to handle it.
That makes total sense.
And that is exactly what options traders are doing right now as they look at Nvidia's upcoming earnings.
Yeah, they are meticulously evaluating the conditions.
Right. And based on what we're seeing, they are pricing in a potential market cap swing of around $350 billion after the results are released.
That is a staggering number. I mean,
Yeah.
$350 billion, that's the specific weather condition we are flying into right there.
It really is.
Just to put that into perspective, a $350 billion swing is the equivalent of an entire major global corporation's value just being created or wiped out overnight.
Wow.
Yeah. Options traders look at the implied volatility, which is basically the mathematical expectation of how wildly a stock will move, and they translate that into cold, hard dollar amounts.
Right. So our mission for you today is very straightforward. We are looking directly at whether Nvidia can still justify the massive AI trade that has lifted semiconductors, data centers, hyperscalers, and AI infrastructure names.
That's the core question.
Exactly. And we're going to identify the specific winners and losers in this scenario. We're strictly looking at the headline, the specific options pricing, and the direct outcomes if we just connect the dots here.
It really just comes down to looking at the actual mechanics of the market response.
Right.
Because when you have a $350 billion expectation built into the options market, it requires a very precise understanding of where the capital is actually flowing.
Yeah, it's bigger than just one company's report.
It's much bigger. The entire technology sector is essentially tethered to the numbers Nvidia reports. And more importantly, the forward guidance they give for the next quarter.
So let's look at the immediate beneficiaries if Nvidia confirms that AI demand remains strong.
Okay.
We are looking directly at the companies making the hardware and the infrastructure that supports it.
Right, the physical builders.
Exactly. If investors continue rewarding companies tied to AI chips, custom silicon, networking chips, and semiconductor manufacturing equipment, the winners are a very specific list of names.
Which ones are we talking about here?
Well, we're looking at NVDA, of course.
Naturally.
Then we have AMD, AVGO, and MRVL.
Right. So that primary group of winners, they fall into the category of AI chip leaders and semiconductor equipment. When we talk about custom silicon and networking chips, we are really talking about the very specific pathways that allow these massive AI processors to communicate with each other.
Because it's never just one chip, right?
Exactly. A single chip doesn't train an artificial intelligence model. It takes thousands of them working in perfect synchronization.
Wow, thousands.
Yeah, and that requires highly specialized networking hardware from companies like AVGO and MRVL.
Okay. And we also have to include the companies that provide the manufacturing equipment to actually build those semiconductors.
Right, the fabrication side.
Yeah, which brings AMAT and LRCX right into the winner category.
You know, you cannot build an advanced semiconductor out of thin air.
Obviously not.
You need highly specialized, incredibly complex fabrication equipment. Companies like AMAT and LRCX, they supply the physical machines that etch the microscopic patterns onto the silicon wafers.
Right.
So if Nvidia says demand is surging, the immediate mathematical reality is that they need to manufacture more chips.
Makes sense.
And to manufacture more chips, the fabrication plants need to buy more equipment from AMAT and LRCX. It's just a direct mechanical chain of demand.
Okay, let's look at this. Is this like building a new neighborhood?
How do you mean?
Well, you need the actual houses, which are the chips, but you also desperately need the plumbing and power grid to make them work, which is the cooling and power systems.
That is a perfect way to visualize the physical realities of the hardware, actually.
Oh, really?
Yeah, investors are looking well beyond just the chips to the entirely separate industries required to keep an AI server running.
Because they run so hot.
Exactly. An advanced semiconductor cannot just sit on a desk. It has to be housed in a server, and those servers require a highly specialized environment.
Right.
Legacy data centers were simply not built to handle the physical demands of modern AI hardware.
Which takes us right into the second part of this group, the data center and AI infrastructure names.
Yep. the plumbing and the power.
Exactly. So if that strength continues, the winners in the data center and infrastructure space are VRT, ETN, SMCI, DELL, and HPE.
To really understand why these industries are completely separate but entirely dependent on this trade, you have to look at the power dynamics.
Okay, walk me through that.
So a traditional server rack might draw a few kilowatts of power. A modern AI server rack, loaded with the newest generation of chips, draws a staggering multiple of that amount.
Oh, wow.
Yeah, and all of that electricity is ultimately converted into heat.
So the plumbing in our neighborhood analogy is actually the thermal management?
Precisely. These components generate massive amounts of heat, and they consume vast quantities of electricity.
Right.
So a company like VRT or ETN, they provide the thermal management and power solutions that prevent the entire system from just overheating or completely failing.
You can't just use a fan anymore.
No, you cannot just point a standard air conditioning unit at these server racks. They require advanced liquid cooling systems, precision power distribution, and very specialized thermal management.
So that is the specialized plumbing and power grid.
Exactly.
Meanwhile, companies like SMCI, DELL, and HPE are physically assembling the servers and storage solutions that house the networking chips and custom silicon we mentioned earlier.
Right, they're the ones putting the entire package together.
Like building the actual house.
Yes. A client doesn't just buy a box of chips. They buy a fully integrated, customized server rack that has the chips, the networking components, the memory, and the cooling systems all built to work together seamlessly.
So SMCI, DELL, and HPE are providing those fully built houses.
Exactly.
So it's a cascading sequence of purchases. You buy the chip from NVDA or AMD, but you cannot use it until you buy the cooling system from VRT or ETN,
Correct.
and then the server rack from the infrastructure providers like DELL.
That is exactly why a strong report from one company extends the rally across all of these related yet totally distinct infrastructure names.
It's all connected.
Yeah, the options traders are pricing in that entire cascading sequence of purchases. If the demand for the chip is real, the demand for the cooling and the assembly is equally real.
Okay, so we have all these incredibly complex, incredibly hot servers being built, but who is actually signing the billions of dollars in checks to buy them?
That is the big question.
Right, and that brings us to the mega cap AI platforms.
Yeah, these are among the biggest buyers and users of AI infrastructure globally.
They're the end users.
They are the final destination for all the hardware and cooling systems we just discussed. They're the ones actually pouring the concrete, building the massive data center facilities, and filling them with these high-performance server racks.
And strong guidance from Nvidia supports the idea that AI spending is still a long-term growth driver for these mega cap platforms.
Absolutely.
The specific winners here are MSFT, AMZN, GOOGL, META, and ORCL.
What is really compelling here is why these specific platforms matter so much to the broader market.
Why is that?
Because they are the ones writing the massive checks that fuel NVIDIA's guidance in the first place.
Oh, right.
When NVIDIA projects future revenue, a very large portion of that revenue expectation is built on the capital expenditure budgets of companies like MSFT, AMZN, and GOOGL.
Capital expenditure, or CapEx. That is the actual cash they are committing to physical assets, right?
Yes, exactly. When a company like META or ORCL announces their quarterly earnings, analysts immediately look at their CapEx numbers.
They want to see the receipts.
They want to see exactly how many billions of dollars are being allocated to data center construction and AI hardware procurement. Those CapEx numbers are the lifeblood of the entire supply chain.
So they are essentially the engine of the entire trade.
They are the source of the capital. If these mega-cap platforms signal that they are committed to AI spending as a long-term growth driver, well, it validates the entire supply chain below them.
Right.
Strong guidance from the chip makers implies that companies like MSFT and GOOGL are continuing to purchase at a very high volume.
Because they wouldn't be guiding high if the orders weren't there.
Exactly. It tells the market that the hyperscalers still see enough long-term value in artificial intelligence to justify spending tens of billions of dollars on the physical infrastructure.
Okay, so what happens if budgets are finite?
Well, that's where things get tricky.
Right. We have talked about the winners, but let's look at the other side of the trade. If the money is flowing heavily into hardware, who gets left behind?
This brings us to the rotation effect. Capital is not infinite,
Right.
Even in a booming market, portfolio managers have to make choices about where to allocate their funds. And that creates our first group of losers.
Right. So if Nvidia strengthens its leadership again, investors may become more selective and avoid names with weaker AI momentum.
Exactly.
These are the chip laggards and weaker AI acceleration names. The losers in this category are INTC, QCOM, MU, and ON.
The mechanics of how capital is allocated dictate that investors only have so much money to deploy.
Yeah.
So if one company is clearly demonstrating dominant AI leadership, the market becomes highly selective. Why allocate capital to a semiconductor company with weaker AI momentum when the primary growth driver of the entire sector is performing so strongly?
Right. It is a matter of relative performance. Even if those laggards are stable businesses, they lose out because the capital is just chasing the strongest momentum.
Investors will actively avoid names like INTC or QCOM if they perceive that those companies are falling behind in the specific race that the market cares most about right now.
They're graded on a curve.
Exactly. The market is constantly grading these companies on a curve. If the curve is being set by a $350 billion expectation, any company that isn't keeping pace with that specific velocity of growth looks like a liability to a portfolio manager.
So they dump them.
They sell the laggards to buy more of the clear winners.
That brings us to another group of losers, which are the software names vulnerable to an AI spending rotation.
This is a really vital part of the dynamic.
If AI budgets continue flowing mainly into chips, servers, and infrastructure, some software names may struggle as investors question where enterprise AI spending is actually going.
Right.
We are looking at CRM, ADBE, SNOW, and NOW. But wait, I want to push back on this a bit.
Go for it.
If a business is spending all its budget on new servers and AI chips, do they just put off buying new enterprise software subscriptions? Is it a zero-sum game for IT budgets?
It's a great question.
I mean, a company still needs its sales software and its document processing software to function daily, right?
They do, but that is exactly the dilemma corporate IT departments are facing right now. Yes, in many scenarios, it operates precisely like a zero-sum game.
Really?
Yeah, every enterprise has an annual IT budget. That budget is an absolute number approved by the board.
Right.
So if the executive team decides that they absolutely must prioritize AI infrastructure, meaning they are buying hardware, servers, and cloud computing resources from those mega-cap platforms, that money has to come from somewhere.
So a chief information officer looks at their budget and literally pauses their software upgrades. They just tell the software vendors they aren't buying this year.
They might delay a rollout of a totally new software platform. Or they might renew existing contracts without adding new seats or new premium features.
Oh, I see.
Think about the mechanics of it. If you need to spend $5 million securing cloud compute resources to train an internal AI model, you cannot also spend that same $5 million expanding your enterprise software footprint.
The money is gone.
Right. The market looks at the aggressive spending on hardware and logically assumes that enterprise budgets are flowing away from traditional software vendors.
So if the money is going to the server room, it is not going to companies like CRM or SNOW at the same aggressive growth rates seen in previous years.
It is a perceived rotation of capital. The investors question the near-term revenue growth for ADBE or NOW because they see exactly where the enterprise dollars are currently being directed.
That makes a lot of sense.
If you are an options trader analyzing that $350 billion swing, you are essentially betting that the hardware companies are extracting a larger percentage of the total global IT budget than the software companies are.
Wow, okay. Here's where it gets really compelling, though. We need to explore a totally different type of loser.
Let's do it.
These are companies that might actually be doing well, but where market expectations have simply gotten too high.
The overcrowded AI winners. This happens after a very strong rally.
Right. Even strong AI-linked names can fall if expectations are too high. A good Nvidia report may not be enough if traders were positioned for a much bigger upside surprise.
Exactly.
The losers in this overcrowded scenario are ARM, TSM, ASML, and KLAC.
We should probably define the concept of an overcrowded trade for you.
Yeah, let's break that down.
An overcrowded trade occurs when a vast majority of market participants have all bought into the exact same idea, driving the stock price up to a level that assumes absolute perfection in future performance.
So everyone is already on the same side of the boat.
Precisely.
Every portfolio manager, every retail trader, everyone already owns the stock because they all read the exact same forecast.
Take companies like TSM or ASML. They are critical components of the AI manufacturing process.
Right.
ASML makes the lithography machines that are required to make the most advanced chips. TSM actually manufactures the chips for the designers.
Very important companies.
They have very strong businesses. However, because everyone knows they are strong, and everyone has already purchased the stock in anticipation of further growth, the price reflects a flawless outcome.
So even if the news is good, the stock can still drop. That feels so counterintuitive.
Does, doesn't it?
Yeah, if a company announces record profits, shouldn't the stock go up?
In a normal environment, yes. But that is the defining characteristic of an overcrowded trade. A company can release good news, or a related company like Nvidia can release a strong report, but the stock still falls.
Because it wasn't good enough.
Right, it falls because the market was pricing in something even better than just good. The options market wasn't pricing in a regular beat, it was pricing in an absolute blowout.
It's like going back to the weather analogy we used earlier.
Right.
If the forecast predicted a perfectly sunny day with 75-degree weather, and it turns out to be 73 degrees with a few clouds,
Exactly.
it's still a beautiful day, but it failed to meet the flawless expectation.
That's a great way to put it. If traders were positioned for a massive upside surprise, and they only get a standard strong report, the reality fails to meet the sky-high expectations.
So they sell.
Consequently, traders begin to sell, locking in profits and driving the price down. When everyone is already holding the stock, there are very few new buyers left to drive the price higher.
Right, there's no one left to buy.
So at the first sign of a merely good report instead of a perfect one, the selling pressure begins.
That is a critical mechanism to understand, especially when looking at names like ARM or KLAC. It is not about whether the company is failing. It is about whether the expectations were simply impossible to beat.
And that brings us back to the $350 billion market cap swing being priced in by options traders.
Right.
That number represents the extreme tension between these expectations and reality. The options market is highly sensitive to that tension.
It sure is.
A single cautious phrase on an earnings call regarding profit margins or future guidance can rapidly deflate an overcrowded trade.
Let's summarize the core facts we have laid out today. This NVIDIA earnings event is bigger than one company. A strong report could extend the AI rally across chips, data centers, cloud infrastructure, and AI platforms.
Conversely, a weak report, a cautious margin outlook, or softer guidance could trigger a sharp unwind across the most crowded parts of the AI trade.
It really cuts both ways.
It does. The capital that rapidly flowed into the infrastructure names, the custom silicon providers, and the mega cap platforms could just as rapidly rotate out if the primary engine shows any signs of slowing down.
When a single earnings report carries a $350 billion expectation, how do you manage your portfolio's risk when the market is priced for perfection?
It's the multi-billion-dollar question.
This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.